The recent wage settlement announced by Lonmin saved the company from a coming cash crunch. Whether the settlement sends a strong buy signal remains to be seen, though. Joining us to discuss Lonmin and the broader resource sector is Kagiso Asset Management's Abdul Davids. So let's begin with whether you are buying Lonmin in bucket loads at this point, Abdul.
Good afternoon. Yes, thank you very much. I think definitely at current levels, we have seen the share price react positively to the latest wage sort of settlement news. But even at current levels, we think Lonmin is probably one of the cheapest shares on our stock market currently. Yes.
Abdul, Warren here. Just to ask you questions around. We've obviously seen during from the time we've had the problem started at Marikana until today, I think the platinum price has rallied about $200 or more. Where does Lonmin stack up in terms of its valuation pre the tragedy and crisis and where we are now?
I think what we have seen is that the platinum price was at about $1,450 an ounce previously. It has recovered, as you said, by more than $200 since then. But even with that, I think Lonmin is almost, you should look at Lonmin independent of the platinum basket price, because the operations at Lonmin is in a turnaround situation. Some of the newer shafts that they're bringing on stream, for example, a lot of capital has been spent, and unfortunately currently those developmental costs that are in the numbers mask the underlying operational and improvements that we have seen in the operating businesses, for example. So as a result, we think that independent of a basket price recovery, Lonmin should actually do very well over the next couple of years as those extraordinary developmental costs start to go down and as they ramp up in terms of the newer shafts as well.
You definitely don't believe that Marikana is going to be the end of Lonmin then?
Not at all. I think whilst the wage settlement is good news, I think the story of Lonmin has always been about the Hossie and Safi shafts, the KE4, which has now been put on care and maintenance as well. So that's a more longer term story. But the mere fact that Lonmin is in a turnaround, it is going to eventually get to the 750,000 ounces in the next couple of years, for example. And as the developmental costs start to go out of the system, we should see significant increases in profitability coming through as well.
Abdul, just on the wage settlement, obviously there's been a lot of opinion around the consequences for the broader mining sector. Obviously Lonmin was, we understand, facing a cash crunch and very desperately needs to get its operations back into gear to avoid breaking debt covenants. In terms of its own survival, it's obviously the wage settlement is positive, but we're now seeing signs of spillover into other areas of the resources and mining sector, as well as talk about municipal workers going on strike. What do you think the wage settlement in its current form means for the broader resources sector, and has it permanently damaged the collective bargaining agreements that exist between industry and labor that we've used for the last 18 years of our democracy?
That's a very broad question and statement in itself. I think, first of all, just to correct some numbers there and some concepts, I think the platinum sector has differed from the gold sector in that collective bargaining hasn't been in place. So each of the operators have had to do their own sort of wage settlements with their respective miners and the respective unions. Clearly, as we've seen in the news, there's been a lot of politicking from politicians that has played into this as well. And we know about the NUM versus AMCU sort of hostilities and the relationships there as well. So unfortunately, Lonmin has been a victim of politics and of union politics on the one hand, and also traditional politics on the other hand as well. And clearly the unfortunate events of sort of mid-August has also blown the wage and the strike out of significant proportion and put Lonmin in the forefront of all that is bad about South African mining, etc. So in the context of that, I think the wage settlement is probably the best thing that could have happened to Lonmin, and we've seen it in today's share price as well. In terms of the settlement itself, there's also a lot of misconceptions about the 22% number that has been bandied about. That is obviously a range of numbers ranging from 11% to 22%, and also it should be seen in conjunction with the 9 to 10% that has been agreed on already. So the effective increment is anywhere between 2 and 10% or 12% wage settlement increase in terms of what they've already agreed upon. In terms of just in terms of what you've said to the broader sort of sector, etc., I think clearly the negative from this settlement is the fact that it does send out probably the wrong message in terms of potential further strikes and what you can achieve if you sort of have large-scale anarchy in the sector or in a particular industry. So from that point of view, we would certainly view it in a negative light. But again, in the context where, unfortunately, a lot of the politicians, the sort of areas that should have been supportive of Lonmin through this period has abandoned the company. And they were all almost on a limb in terms of trying to settle and trying to negotiate with disparate parties in terms of reaching an agreement.
Abdul, I want to jump now to the broader trend in the market that we're seeing, and that is the sector rotation out of industrials into resources. Is it set to continue? Do you believe, firstly, that the time is up for the industrials as we know them, specifically the retailers?
Yes. I think we probably are of the view that the time was up probably a year ago already. In terms of the re-rating that we've seen in terms of the industrial sector, that has obviously been quite significant, especially post the global financial crisis in 2008. And we believe that that was symptomatic of almost this defensive qualities that a lot of global and local investors were looking for in terms of companies that have had fairly resilient earnings and earnings growth stories. There's a sub-theme of Africa in terms of African growth that people were, and especially foreigners, were chasing. And then on top of that, people were looking for yield as well, dividend yields that are fairly juicy and lucrative, especially compared to global interest rates, and then also to have a growing profile in terms of your dividend as well. Unfortunately, what that has resulted in is a significant re-rating of our industrial sector to levels that has been unprecedented. We look at multiples that are in the sort of areas of between 25 to 35 for a lot of the retailers, unknown territory in terms of a lot of those ratings, and significantly above the longer term ratings and averages as well. In contrast, we have seen the resources sector obviously coming under pressure. Granted, in certain areas, resources earnings are at very high levels and will probably come down as commodity prices have softened. But we are of the view that it is much more comfortable being in a resources space where you're paying 8 to 10 times earnings multiples for, albeit declining earnings, but normalized earnings probably 10 to 20% below current levels of earnings, versus an industrial sector where earnings are very high and multiples are very high as well.
Abdul, just on that note, obviously the argument with the resources is that in South Africa you need to be very selective because the cost side inflation is very high. In fact, if you use Lonmin's model, it's gone up 22% in the last 6 weeks just in labour alone, and that's not taking into account electricity. Within the resources, what are the specific companies and your thinking around which companies to invest in the sector?
Again, yeah, as you rightly say, you have to be selective, and our approach at Kagiso Asset Management is a bottom-up approach. So we wouldn't take a broad brush and say buy the entire resources sector. We would be quite selective. Especially if, we will look at the underlying commodities. So for example, iron ore, we've seen iron ore prices coming down quite significantly. It has started to recover, but still significantly lower compared to, say, a year ago. And in that case in particular, we think Kumba iron ore is still overvalued at current levels, even though the share price has come under pressure as the iron ore prices come down. And then certainly some of the other sort of more diversified miners, we think BHP Billiton is probably close to fair value, to slightly overvalued. And again, as we know, BHP Billiton has substantial iron ore assets and iron ore exposure as well. In contrast, Anglo American, probably the cheaper one compared to BHP Billiton. Whilst we acknowledge that Anglo is probably the poorer cousin to BHP Billiton, given its probably inferior quality management and slightly lower or inferior quality of basket of commodities. But with that, we think Anglo's is quite attractive at current levels. And then obviously, as you know, and we've discussed this before, the platinum sector we think is quite attractive. If we then move on to the oil and gas, I think Sasol is probably one of the cheapest stocks that you can buy. It offers both the defensive and valuation underpins in terms of a very lucrative dividend that is set to grow given the company's progressive dividend policy. And you've got potentially exciting prospects in the GTL story that is, albeit a longer term story, can add quite significantly to the valuation as well.